Hello students, we continue chapter 15, investment time and capital market from microeconomics Pindai. So we are now at 15.5, adjustments for risks. Risk premium is amount of money that a risk-averse individual will pay to avoid taking a risk. Alright, I repeat, amount of money that a risk-averse individual will pay to avoid taking a risk. That means they want to make sure that the income they receive is more or less covered for. Okay, they can't guarantee it, but they are reducing their losses. They try to protect their income from adverse effects of the investment or the business not being successful. So because you cannot guarantee the future, you cannot guarantee what will happen to sales or revenue in the future. So you add that risk premium into your calculations, into your business decision making process. Okay, there are two types of risk. One is diversifiable and the other one is non-diversifiable. Diversifiable risk is that the kind of risk which you can spread over many projects or holding by many companies. So we call this diversifiable. Usually in business or in capital market language, we say let's put this in a portfolio of investment instead of just focusing on a single investment. Alright, a portfolio, so some will go up, some will go down, some will be more successful than the others. So on average, they will still be positive. So you are saying that you are using the portfolio approach. Okay, and since you are able to diversify this, if you have a good management portfolio management strategy and you always review, then there is no need to consider or adding a risk premium to the existing discount rate. Okay, is that clear? All right. But non-diversifiable risk, is risk that cannot be diversified just by spreading the stocks by over many companies. Usually this is a risk that comes with the overall economy downturns. Okay, so this is very cyclical, that you can't just like take 5 companies, all 5 companies will be affected if you have an economic recession. Okay, so in that case, the opportunity cost of investing in a project is higher than the risk-free rate. So in such a case, we do add a risk premium to the discount rate. Alright? So a capital asset pricing model is usually used. It is very popular in finance, corporate finance. The risk premium for a capital investment depends on the correlation of the investment's return with the return on the entire market. Okay, so the expected return on the stock market is higher than the risk-free rate. The rule here, or the basis here, is that the expected return on the stock market, okay, which we will call RM, is higher than the risk-free rate. What was the risk-free rate? The portfolio one, right? When we assume that our R is R risk-free is equals to the R discount rate. No need to add anything else. So the risk, this is risk-free. So if you choose to put or to add a risk premium, then the risk premium value will be the risk premium on the market will be RM minus RF. Okay, the risk premium will be RM minus RF. Okay, and with risk you get higher yield. That's the reason why we are looking at risk just now. Alright, so let's spell out the equation. R interest or investment that you're having now minus the RF, or the risk-free interest rate, is equals to beta R, this is the risk at the market, minus the RF. So in other words, on this side, on the left hand side, is the expected return of investment minus the risk-free return. Okay, is correlated through beta. It could be 1, it could be 2, it could be twice, it could be 3 times the right hand side, which is RM, or the risk from the market, minus the risk free. So the non-diversifiable risk minus the risk free rate. So the equation says that the risk premium on the asset is proportional to the risk premium on the market, and that proportion is reflected by your beta. So what is the asset beta? A constant that measures the sensitivity of an asset's return to market movements, and therefore the asset's non-diversifiable risk. So if 1% risk in the market results in a 2% rise in the asset price, okay, remember why we say price? Because the rise in the market, the trend in the risk in the market is reflected in the risk of your asset or your investment. And this risk is manifested by price. So if this price change, then your price will also change. And if the relationship is 1 to 2, then your beta is 2. Okay, if the beta is 0, that means the market risk, 1% rise in market risk tends to, let's say beta is 0, we go back to this one. If beta is 0 here, that means the market risk does not affect, because beta is 0, everything on the right hand side will become 0. So beta will not affect the difference between your investment and the risk free. So that means you are the same. You don't have any risk if beta is 0. Okay, if beta equals to 1, that means the risk from the market is the same as the risk that you should expect for your business, for your firm's investment, for the investment. If 2, it affects it twice. 2 times the risk. That means the price is also probably 2 times higher, because risk goes with price. Remember? Okay. Now, what is the adjusted risk-adjusted discount rate? Risk-adjusted discount rate is the RF plus beta RM minus RF. Okay, so let's say risk-adjusted interest rate just now is risk-free rate, okay, plus a risk premium to reflect the non-diversifiable risk, the RM, the market just now, the economy's risk just now, and what beta is it linked with through, what beta is it in the market. So this beta is a subject of regression analysis. You want to determine what's the beta in this market. So some countries beta are higher, some countries the beta are lower. Okay. All right, we continue with the other. The decision to buy. Okay, now let's see how we've seen just now all the investment decision making process that goes through an investor's mind. Whether they are opening a business, or they are buying bonds, or they are buying stocks or whatever in the market, in the capital market. The 15.6 is the same kind of investment decision, except that this is from the consumer's perspective. Okay, and the scope is the consumer and what they want to buy. We are looking at their decision making to buy durable goods. Okay, so same thing, if you're going to buy a car, $25,000 for instance, you will be comparing the future benefit of that car versus the amount that you are paying now, $25,000 for instance. If you're paying cash or if you're paying over a period of time, we will consider that in our NPV expression. Okay, so let's say the service, let's start with this example, the service is S dollar, yeah, or the benefit that the car gives you is S dollar. Operating expense is E. The car price is 20. Resale value, scrap value is 4. So let's frame this on the NPV as the price just now, 20K, plus the first year of operating expense will be the service minus the expenditure. Since this is the year that you purchase it, first year is okay, plus the second year minus, this one is after first year of using, until 1 plus R, 6 years. Okay, let's say you use the car for 6 years, N is 6 years, and then don't forget the scrap value at the end in the 6th year. Okay, so that's the presentation. What current year, second year. Okay, which discount rate would the consumer use? Same principle, depending whether the money is from the foregone investment or the money is from borrowed. Okay, so borrowed, cost of your borrowing. What's the interest rate that you are charged with? Okay, 15.7 looks at the same decision, but on a very intangible product, knowledge. How do you value your investment in knowledge or experience or skills? For instance, what is the value of taking an MBA, for instance, after you graduate? Okay, so the example here is that the economic cost of attending college is 40K for each year for 4 years. So the N is 4. But after that, you'll be working and you can earn $20,000 per year more than a high school graduate. So the return from this investment is 20K per year. If you don't take the degree, the return the degree, that will be zero on top of whatever you're getting now. But if you get the degree, then from compared to SPM or A levels, you will be able to earn 20. So that's your income stream. So, and we say that this 20,000 salary is going to continue in another 20 years. So you have 4 years of studying and 20 years of working. In that case, the NPVs in thousands of investing will look like this. Okay, so the cost per year is 1. So the first 4 years, your NPV will look like this: negative 40 plus negative 40 first year cost, negative 40 second year cost. This is all your student days, your college. Alright, so this 4 years is the cost, all negative. Negative is because if you look at the example, negative 40, it's actually the fees 20K, and then the loss of income for attending classes. For attending college is another 20. So that's the story how you got 40 actually. Okay, and then after that you will start earning a difference of 20. Okay, but that is 4 years later. plus until year 1 plus R until 24th year. 23rd. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 20. Okay, so this is the expression. And a reasonable discount rate that will give you NPV. Remember, the rule is still NPV must be equal to 0. Must be greater than 0. So the minimum discount rate here that you are willing to bear will be 5%. If the cost of money is more than 5%, then this is not worth doing it financially. Okay, for example, the borrowing cost at you want to borrow to study, you have to borrow more than 5%. Let's say 7%, then it will be too expensive to pursue a college education. Okay? So you must find the discount rate for that. A reasonable real discount rate is about 5%. Remember, there's word real here, that means not nominal. At this point, the NPV is greater than 0, 65%. So that will make the decision a good decision. Okay. All right. The last section is the second last section is how do you decide on depletable resources? Let's say PT is the price of oil this year, PT plus 1 is the price next year. Oil, you have oil. So do you keep it or do you extract this year or you extract next year? So if you extract this year, you get the revenue based on PT, the year itself. But if you extract next year, then your revenue will be based on PT minus PT plus 1, PT plus 1, alright, and the cost of extraction is C, so both must be deducted by C. But since it is next year, then the PT in today's value, for you to know what is it in today's value, you have to use the 1 plus R formula. Okay, so the decision is like this. Should we extract this year or should we extract next year? Depends on what we know about the future value of the second decision. Right? If PT plus 1 minus C, that means what you get if you extract next year, 1 plus R, is greater than if you were to extract this year, PT minus C, then the decision would be to keep the oil next year, for next year. So as simple as that. Okay, in your textbook it's written like this: PT plus 1 minus C must be greater than 1 plus R PT minus C. So they brought this one up. Okay, but the decision rule is still the same. If this one is higher, then keep the oil next year. If it is the same, then the company is indifferent. You can extract the oil this year or next year. Yeah? If it is less, it's better to extract now. Okay, so if cost is constant, then no need to consider, just consider or decide based on what you think the price will be. You expect price will go up more or fall in the year after this year. Okay, so that the science of deciding, decision making in renewable or depletable resources, because you know that once you invest, you make that expenditure, the effect will be on your future stock. There will be future stock implications there. So therefore your decision must be really, really well timed and really well thought out. Okay, you can read this, it's very interesting. Same thing, user cost. If it is a monopoly, just now we were considering a perfect competition. If it is a monopoly, the formula is the monopoly, the formula is just a bit different, in the sense that instead of using P just now, you will use MR. This goes back to our story about, so you decide 1 plus R MR T minus C. So the only difference is instead of using P just now, we use MR. And monopolies, P is larger than MR. Okay, so the interesting result is that a monopolist will end up more often not extracting now, because P is less, the MR is always less than P. And it also charges a higher price and deplete the resources more slowly. You can work out the formula, because MR is less than P. Okay, 15.9 is for your reading, and that's all for this chapter. Thank you very much. Okay.